Let's get more now on the market moves. Chris Conway from the Australian Stock Report joining us now live from our Melbourne studio. Chris, great to have your company on the show today. I want to kick it off with markets in general because we're up about 0.6%. Yield plays seem to be leading the way again today. Can you read into that at all?
Yeah, good morning, Ingrid. I think what's happening there is people are expecting the unemployment numbers to maybe come in a little bit weaker than expected at 11:30 a.m. this morning. That, of course, would feed into the probability that the RBA would cut rates and fuel that yield play. So that might be a bit of what we're seeing there.
Okay. You've been talking a lot about the market perhaps retreating. It has retreated now 5,828, below that 5,800 level, of course, over the last couple of sessions. What do you make of that? I mean, are we now edging away from that 6,000 level, or is there still a chance for us to get there, and what would get us there?
Look, I think it's all about what the central banks around the world are doing. Obviously, the Fed and the RBA. The bulls are believing that the RBA might cut rates sometime in the next couple of months, and that, of course, would provide support for the local market. Alternatively, the bears are worried about what the Fed are going to do and potentially raise rates again a little bit later in the year and turn off some of the easy money that has been fueling global market rallies around the world. So, look, when I was on last week, I spoke about the market retracing into 5,800. That was on the back of the RBA not cutting rates. Of course, they didn't. We find ourselves at 5,800 now. There is some technical support down at 5750, but it really is a waiting game at the moment. Everyone is just waiting to see what central banks are going to do. And in the 10 years that I've been involved in markets, I've never known day-to-day price action to be so impacted by what central banks are going to do.
Yeah, volatility certainly increasing this year from what we saw last year. But just looking at the US dollar strength we've been seeing lately, obviously with the Aussie dollar dipping below that 76 US cent mark overnight, what do you make of the movements in the US dollar going forward? Obviously strength expected, but what does that mean for your investing in Australian shares? I mean, are you looking for ones with US exposure?
Yeah, absolutely. I think the smart way to play it now is to look at companies that have strong US dollar earnings. We've already seen out of the back of reporting season that those companies that had significant US dollar earnings performed or generally performed better than companies that only had Australian dollar earnings. Australian earnings were hard to find throughout the reporting season. So companies like CSL and Cochlear, as well as James Hardie, they are the companies that have significant US dollar earnings and are likely to benefit from a falling Australian dollar.
But you think they've got further to run? Because obviously that's pretty much priced into these stocks at this level.
Yeah, well, I think, again, it depends on what the central banks do. So if we see the US raise rates and as well at the same time the RBA cut rates, it's almost guaranteed that the Aussie dollar is going to move lower, whether that be to 70 cents or 65 cents. And that translation effect as those companies repatriate their US dollar earnings will be a boon for them. So, yeah, we still think there's more in that move, most definitely.
Looking at the mining space, one we've been talking about a lot lately on the program, given the fact the iron ore price just seems to continue to plunge. Tim Schroeder's coming out from Pengana Capital saying basically he thinks this is an attractive entry point for some of these mining stocks, given the fact that they're operating below their long-term potential. He's saying the sector is under-earning. What do you make of that? Because there's a lot of different kind of discussions around whether or not you'd want to buy into these stocks at these levels.
Yeah, specifically mining companies, longer term we think there could be some value there. Shorter term there's always the potential that they'll move lower. What has tended to be the whipping boy in that space, though, is not mining companies as such, but mining services companies. As CapEx has dried up and projects have been shelved, those companies have been punished. So we're talking about names like Monadelphous, Bradken. They have fallen significantly, and again, on the back of movements in the Australian dollar, we think there's still further weakness there. So for the shorters out there, they're the stocks that we'd most definitely be looking at.
I'm not sure if you're watching Whitehaven at all, but this stock today is up about 8% on securing some funding. It secured about a $1.4 billion loan facility from a syndicate of local and international banks. What does this say about the viability of these stocks going forward? The fact that they can get this sort of funding still at these levels when the iron ore price is doing what it's doing?
Yeah, look, that's a really interesting question. I haven't taken a real close look at the machinations of the Whitehaven funding this morning. The fact that funding is still available out there suggests that there is some support, but not all of these players necessarily are going to survive. So again, it's a matter of picking the companies that can continue to perform. And of course shorting or avoiding those ones that really are stressed at the margin and have a chance of tipping over.
All right, so if we see this unemployment rate back to that, if we see that beat expectations today, what do you expect the equity market to do in response?
Look, if the number comes in, or if unemployment falls, as there is some expectation that it will, then that will of course decrease the probability that the RBA is going to further cut rates, and we might see a further pullback in the market. We're not quite as bullish as everyone else out there. We think that number might disappoint. It moved from 6.1% to 6.4% last month, so the trend is to the downside. It could, we think that the unemployment rate might in fact increase, and that of course means that the RBA would be more likely to cut, and that yield play will once again remain firmly in focus.
Yeah, certainly an interesting one to watch. The good news is bad news scenario certainly playing out in the United States. Chris Conway, thanks so much for joining us today.
Thanks Ingrid.
Out of our Melbourne studio.